It never begins with a scream, it begins with a ping-in alert on a trading desk, a margin call, a missed payment so small it barely registers. Then the air thins, liquidity evaporates, and what looked like a minor wobble becomes a mechanical cascade. If 2026 becomes the year the market buckles, it won't be because no one saw it coming. It will be because too many people thought they had time. You're watching Hidden Finance, where we decode the hidden forces behind money, power, and the markets shaping your life. If you've ever wondered why some people grow quietly wealthy during storms while others are swept away, you've landed in the right place. Here, we don't chase predictions, we study patterns and prepare for probabilities. Stay with us as we trace the roots of a potential 2026 crash, the pressure points that could make it snap, and how those who prepare can transform chaos into an edge. Welcome to the story behind the screens. To understand 2026, we have to rewind. After the 2008 crisis, central banks rebuilt confidence with zero rates and a river of money known as quantitative easing. Debt became cheap, risk-taking became normal, and a global economy found its footing by leaning hard on the price of time. For more than a decade, the cost of waiting interest was near zero, and everything that depended on it inflated: real estate, equities, venture capital, and the promise of tomorrow. Then came 2020, a pandemic that shut the world and opened the monetary floodgates again. Stimulus checks, emergency lending, and a burst of digital life demand lit markets like a match. Tech valuations roared, meme stocks and crypto turned markets into a social phenomenon. Speculation became sport. Underneath it all, supply chains buckled, and the seeds of inflation were planted in real time. By 2022, the bill arrived. The sharpest inflation in for decades and a Federal Reserve forced into the steepest rate hikes since the 1980s. The era of free money ended, and the hangover began. In 2023, we saw the first cracks: Silicon Valley Bank, Signature Bank, and Credit Suisse, a reminder that interest rate risk, ignored for years, was stalking the system. Pain was not evenly distributed, it rarely is. The fragility was visible if you knew where to look. Banks loaded with long-term bonds saw unrealized losses pile up as rates rose. Commercial real estate, especially offices, struggled as hybrid work rewired demand, leaving landlords and lenders facing refinancing at higher costs. Leveraged loans and private credit filled the gaps that banks vacated, moving risk into a shadowy, less regulated corner. Investors kept dancing because prices rose, especially for a handful of mega-cap technology stocks that carried entire indexes on their backs. By 2024 and into 2025, a new narrative took hold: artificial intelligence and the promise of productivity. Money chased the magnificent few, passive flows added fuel, and earnings multiples stretched like taffy. Buybacks returned in force, options volumes soared, and traders rode intraday waves like surfers on a restless ocean. It wasn't euphoria everywhere, but in the places that mattered for indices, it felt like gravity had been negotiated away. Meanwhile, forces outside the spotlight gathered weight. The United States ran large fiscal deficits even in good times, issuing oceans of new treasuries that needed buyers. Hedge funds piled into basis trades, borrowing to exploit tiny price discrepancies between futures and cash bonds, profitable until volatility rises. Dealer balance sheets, tightened by regulation, had less room to intermediate when markets get disorderly. A market built for calm was quietly becoming allergic to surprise. Globally, the picture didn't soothe. China grappled with a prolonged property slump. Evergrande and its peers taught an economy built on real estate what deleveraging feels like. Europe navigated energy shifts and sluggish growth, while pockets of its banking system kept one eye on real estate, another on sovereign debt. In Japan, even a small shift away from yield curve control hinted at a great rebalancing. Japanese capital, long a beer of foreign bonds, might one day come home, pressuring global yields. The world's financial plumbing was more connected than ever and more sensitive than it looked. By the mid-2020s, private credit exploded, promising yield where public markets seemed picked over. For businesses that couldn't tap cheap bank loans, it looked like salvation. But many loans were floating rate, and as rates rose, interest bills ballooned, quietly, relentlessly. Behind closed doors, covenants were renegotiated, cash flows were stretched, and extend and pretend bought time at a price. Now imagine a plausible path to a 2026 break. It doesn't take a meteor strike. It takes a disappointing earnings season that turns into an outlook downgrade, a hiccup in the treasury market that becomes a funding scare, or a large borrower that fails to roll debt. Any spark that convinces investors the narrative has changed, and markets conditioned to buy the dip. The first dip is bought and then fails. That's when machines take the wheel, systematic strategies cut risk, options hedgers sell into weakness, and liquidity recedes like a tide. One turning point could be a weak treasury auction that drives yields higher just as growth cools. Higher yields stress risk parity funds, tighten financial conditions, and magnify pressure on leveraged players. As the price of money rises, equity valuations that assumed yesterday's rates adjust brutally. Basis trades unwind, funding costs spike, and what began in the safest market, the treasury market, triples everywhere. Another pivot point could be the refinancing wall in commercial real estate and credit. Office towers built for pre-pandemic demand face mortgages coming due at far higher rates. With lower valuations and fewer tenants, regional lenders, already nursing losses on low-coupon bonds, confront rising delinquencies and reduced collateral values. If one lender stumbles, confidence financing's oxygen thins for all, or the spark comes from abroad. A sharper slowdown in China saps global demand and commodity prices, crushing earnings for industrials and exporters. A policy surprise in Japan pushes global yields up, repricing every asset priced off the risk-free rate. Investors scramble to adjust, and the scramble becomes the story because speed itself is a risk factor in a world of instant information. Policy responses can help but sometimes misfire. A rate cut meant to soothe can be read as fear, not confidence, signaling that the patient is sicker than expected. Emergency backstops can stabilize plumbing, but they can't force buyers to want risk tomorrow. When volatility climbs, hedging becomes expensive, and those who didn't plan ahead are forced sellers at the worst moment. Markets don't crash because everyone panics. They crash because too many must do the same thing at the same time. In that kind of sell-off, nothing feels safe. Equities fall together, the generals and the foot soldiers. Corporate bonds gap wider as downgrades loom, while the illiquidity of private assets reveals itself, and stale marks and long queues at redemption gates. Crypto can act like a high beta risk asset, amplifying the swings in both directions. Even cash-like vehicles are tested if money market plumbing strains, though in true panics, dry powder regains its old dignity. The human cost is not an abstraction. Companies slash hiring, then jobs. Bonuses disappear, IPO windows freeze. Pensions and endowments recalculate spending, municipalities tighten budgets. Households pause big purchases with a hand hovering over the buy button. The wealth effect works in reverse, and confidence, a delicate ecosystem, becomes an endangered species. Inequality, born of the boom years, broadens the gap in losses, too. Globally, the shock radiates. Stronger dollars pressure emerging markets with dollar debts. Capital retreats to perceived safety, leaving weaker countries to pay more for less. Commodity exporters face lower prices. Commodity importers face slower trade. Supply chains that had begun healing seize again, not from a virus this time, but from the contagion of finance. What we call the market is in fact a web of promises, and when a few snap, the web trembles. So where in all this is the opportunity that could make you rich? History's answer is consistent. It is created before the storm, not during it. In crashes, assets don't just fall, they are repriced to levels that assume a bleak future forever. If you prepare, if you've done the work, then forced selling by others becomes a once-in-a-decade chance to acquire great assets at distressed prices. Fortunes are built when your timeline is longer than the market's memory. Preparation is not prediction, it's architecture. It means defining what quality looks like before panic, so you're not inventing standards under stress. It means maintaining liquidity, true dry powder that doesn't rely on margin, redemption windows, or the kindness of markets. It means building a watch list with price and yield thresholds that turn fear into triggers and triggers into disciplined action. It means knowing which businesses earn real cash, carry resilient balance sheets, and can grow through recessions, not just around them. Historically, investors who navigated crashes successfully used rules, not vibes. They scaled in gradually rather than trying to nail the bottom. They diversified so no single thesis could sink them. They avoided leverage that turns drawdowns into disasters. They rebalanced because in chaotic markets, volatility pays those with the courage and structure to sell what's dear and buy what's starving. And they treated tax losses not as failures, but as raw material for future gains. Tools exist, but they demand respect. Broad index exposure can be a simple way to capture the eventual recovery, while factor tilts toward quality and value have historically outperformed after bubbles deflate. Distressed credit has created generational fortunes for those who truly understand covenants and capital structures, but it punishes tourists without expertise. Options can hedge or amplify, but in storms they become expensive and unforgiving. They're power tools that require training, not toys for a panic. The best strategy is often a mindset, buying when it feels awful because you prepared when it felt good. The most important capital in a crash is psychological. Fear makes cheap feel dangerous and expensive feel safe. It rewrites your memory and steals your compass. That's why you write your plan today, what you will buy, how much, and under what conditions, so that tomorrow you follow the plan instead of your pulse. You won't get the bottom, you don't need it. You need process, patience, and the humility to let time do the compounding. Look back and you see the rhythm: 1907, 1929, 1973-74, 2002, 2008-9. 2020, each crash had a new villain and an old lesson. Leverage makes the fire spread, liquidity vanishes faster than models predict. Policy can cushion, but it cannot cancel the cycle. And yet, each time, those who owned durable cash flows, bought at good prices, and held their nerve emerged with more than they entered. What makes the coming years different is speed. Information travels at the speed of anger, trades execute in microseconds. Algorithms interpret mood faster than humans form it. Zero-day options compress risk into hours. Passive flows can turn outflows into air pockets. In that world, the edge is not being first, it's being ready, with cash that won't run, rules that won't bend, and patience that won't crack. If 2026 brings a crash, it won't be the end of markets. It will be a transfer of ownership. Assets will move from the leveraged and impatient to the liquid and prepared. The question isn't whether you can call the date. It's whether you can build a plan that makes the date irrelevant. The real opportunity is to turn volatility into value by design, not by accident. So here is the hidden finance way to think about it. Map your scenarios, not someone else's headlines. Identify the businesses, sectors, or funds you would be proud to own for a decade if prices fell in half again. Decide what cheap means to you on earnings, on cash flow, on yield, and write it down. Keep your powder dry in instruments that won't vanish when you need them most, and automate as much of your future self's courage as you can with pre-committed rules. Then let the market's fear do your negotiating for you. We're not here to tell you what happens, we're here to help you be ready for whatever happens. That's the distinction the greats make between prediction and preparation, between noise and narrative. And if 2026 becomes a year of forced sellers, your preparation could be the quiet engine that turns their panic into your patience. That is not bravado. It is the lesson of every cycle, reeled in by every generation that survives one. If this exploration helped you see the landscape differently, stay with us. Hidden Finance is where the stories behind the numbers become practical insight, where we connect history's echoes to today's decisions. Subscribe, share, and join our community on YouTube and Facebook because the next chapter will be written fast and you'll want a guide who reads the fine print. We'll keep decoding the signals, highlighting the fault lines, and separating urgent from important. This is Hidden Finance, where preparation becomes your unfair advantage. In markets, you rarely get to choose the storm, but you always get to build the ship.